Okay, we're live. Good morning, everyone. Welcome to this rainy day if you're in New York. Let's see. All right, we're live. Yeah, I was just telling a friend about when our bankers decided to try to pitch us a bankrupt company. Yeah, so you'll be surprised some of the small things that some of the basic financial stuff can get you pretty far, even on Wall Street. Like we had this one time where our bankers came to us and we were in research and they had this small company that was telling they're like, hey, there's a small tech company. They wanted to maybe come to us, raise some stock. And it's like this guy who's a lot of experience. And then they're asking us like, hey, do you think we could pitch this story? Like they want to raise some money with a secondary and then do some tuck-in acquisitions. And on the, as they're pitching this to us, I was looking through I just pulled up the filings real quick and I just looked at the 10K. And, you look at the cash flow statement, you look at the balance sheet, and I'm like, okay, so this has a little bit of balance, has a little bit of cash, but it doesn't really have much cash on its balance sheet. And you'll look at free cash flow and like, okay, it's burning probably about like, I think it was like 10, 15 million a quarter. Anyway, so they had 15 million on their balance sheet. So this company was actually 1 quarter away from bankruptcy. And so this wasn't a pitch at all. This was we need to raise stock so we don't go bankrupt. So needless to say, we called our bankers back and like, I'm not sure we can pitch a bankrupt company. So anyway, that was the end of that deal. And sometimes you just need a couple small things. And the real lesson is you just don't want to trust bankers. Just half kidding. 20% kidding. Okay, welcome everyone. If you're just joining, just say hi, check in, tell me where you're at, what location you're in. I'm in New York. Looks like it's raining outside, but we're doing okay. Hope everyone's doing well. It's going to be exciting. New training, and just if you have any questions, you can post them in the chat, and we'll address them, and we'll answer them, and it's going to be a great presentation. So we're going to jump right in. Okay. Let me just put on my screen. Okay. All right. So day 2, reading financials. This one I'm super excited to share with you. Because, I came from a Wall Street background. I've equity research, spent 7 years being an equity research analyst at BMO. And I also have the CFA, or I'm a CFA charter holder. If you're a CFA ticker, you have to speak to it in a very specific way. But I picked up a lot of financial experience in terms of reading financial statements and doing financial analysis, mostly on the job. So I used to be like you in terms of I really had no accounting training. I had no finance training. And really, I picked all this stuff through doing the job of modeling companies and reading financial statements from a research perspective. So I'm really excited to share with you some of these tips that I've learned to help you when you look at stocks. And specifically, we're going to talk to you about avoiding bankruptcy. So now this workshop is for you. If we're doing our job correctly, is that you're looking for a process, you're looking for a framework to evaluate stocks. You might have some gaps in your knowledge and you're not sure how to value stocks. You have limited experience with things like financial accounting and models, and you want to trade, or you don't want to trade, and you want to do fundamental investing, but you just don't have the time to learn. So that's where we come in. We help you with a fundamental process to help you pick great stocks And so you have the financial analysis and investment skills really to improve your portfolio's returns. And so in this series, this is day 2 of the series, we've covered how to identify a stock opportunity. Oh, excuse me, give me 1 second. I need to have an electronic that is going off. But okay, so we already went through how to identify a stock opportunity. Today, we're going to go over how do you read financials to avoid taking excessive risk. Tomorrow, we're going to go over how to research stocks to find what's most important from an investment standpoint. And finally, our final event, we're going to go over the fundamental investment process from my Wall Street background, from equity research, so that it helps you pick great stocks. You want to register for that event, and that's going to be the great one. Okay, so end goal for all these trainings is really to get you to have a confident process and the confidence to pick stocks for your portfolio. And the reason that you want to pick stocks for your portfolio is obviously to find higher return opportunities. And when you have clarity on the right stocks to pick and the right stocks for your portfolio, you can start to achieve your goals faster with stock investing. Now, so today's topic, we're going to go over how to read a financial statement, but we're going to do this through a case study. So I'm really excited to share this case study because this is from when I covered the education industry. So back in the day, the for-profit college industry was a real boom industry starting in around 2008, 2011, or 2008 to 2011. One of the biggest stocks or companies was Corinthian. They had the largest college base. They had the largest network of campuses. And then in 2010, 2011, the Obama administration started to crack down on for-profit colleges. And this company, which started off as a high flyer, eventually went bankrupt in 2015. So we're going to walk through the financials. I'm going to show you exactly the signs that showed this company was at bankruptcy risk. And really, we're going to answer the question, how did this high flyer go bankrupt in just 3 years? Now, there's 3 things that happen when a company gets into this bankruptcy type risk situation. There's negative earnings, there's negative free cash flow, and there's a declining balance. So you want to pay attention to those negative trends. And we're going to go through each of these specifically through the financial statements. So starting off with the income statement. So the income statement is the profit and loss statement. You want to think of this as like the performance of the business. So the first sign of trouble is obviously when there's no profit. So the income statement, really, it's a record of the different transactions of the business. And that's where you assess if the company is just performing well in terms of its operations, ideally making money. And so the first sign is when the company is not able to make profit. So what do we look for? We start off at a high level. We look at the revenues. We look at the different expenses. We make adjustments if necessary. And ultimately, we're looking to calculate the true earnings of the business. And that's where we might use something like adjusted earnings. So let's walk through this real quick. So this is a Corinthian income statement. This is starting in 2011. Right when there was pressure on the industry. So right away, you can start off at the top line. Now, and in terms of the structure of the income statement, we start off at the top line. And here we have our different line items, the different cost line items. And then we get to the income from operations. That's the profit of the operations of the business. We have our finance-related expenses over here. And then we get to our pre-tax income. And then finally, our net loss, which is net loss here, but the earnings of the business. And that's why it's also called the bottom line of the profit and loss statement. So our first sign, if we're looking here, is we can see revenues, and we have to read from left to right just because it's a filing. And we can see that revenues have already started to go down. So that's where we can see the pressure from the restrictions from the government have already started to kick in on the business's top line. And just looking at the bottom line, we can see that they're not making any earnings. But on first glance, it does seem to be getting better. So now that here's where we start to look into the individual cost items. You want to look for things that kind of stand out in order to just check in and see what the story of the business is. So here we can see that a big cost item here is impairment. Now, if we look in the filing and we look at some of the explanations of what's going on, and you can find this in the 10K or the 10Q, impairment really means that they have taken a write down of their business. So some of their assets are just not performing as they used to be. So they have to take a write down in terms of the value of the assets. Because of the write down is just an accounting change, that actually doesn't involve any cash. So one of the adjustments that we do want to make is there's just some some one-time charge that happens in the income statement, we basically want to adjust for it so that we can look at the true earnings of the business. So if we take that out, we start to get adjusted earnings. That's actually 108. So that's not bad in 2011. And then that dipped down to 1.9 million. So now we still know that earnings are just basically break even, and they've come down. But now let's look at what are the other cost items. So here we have this thing called other expense. Now, if we look in the filings, what that actually is the cost related to loans. So what's going on here for this, from this statement's perspective, is in 2011, there was some pressure on the company from the government. They started to restrict student loans. Now, the company also decided to create their own loan program, but this loan program started to have its own costs. It started to be very expensive, and you can see that over here. So costs have started to come up from this loan program. We have revenues declining. And so basically, at the end of the day, the total earnings for the business have basically dropped to barely break even. And that's after looking at adjustments. And so our takeaway here is, okay, this business is not really doing very well. And if the business is not making any profit, we start to have to think about, okay, what are his cash flows? So the action steps here, really, you want to start to look in the income statement of the company, either in a 10K and 10Q, look for the revenues and the expenses. Just find what stands out. And the ultimate goal is you want to figure out, can the company turn a profit? And if not, we want to check the cash flows. So the cash flow statement is like one, it records the cash movements of the business, and it's a little bit like the oxygen of the business. A business cannot survive without cash, and it sort of measures the different ways in cash moves in and out of the business. So the general three buckets that we have are operations, investments, and financing. Cash from operations represents all the cash that is generated by the business itself. You know, it's so for this one, it's its campuses, it's tuition, it's cost of teachers, and so forth. Investments is when you put in money into the business. Say if you buy a campus, you invest in some facilities. Financing is when you start to raise money from investors, or you have to pay back money to investors or to the bank. And so really at the high level, what we're looking here is we want to figure out, is a business producing cash or is it using it? Because if free cash flow is negative, that means that the business is burning cash, which is not a great sign. So what we look for to simplify the statement is we look at the net cash from operating activities. That represents the cash flow that is being generated by the business. We look at capital expenditure. That represents the investments into the business. And so when we take cash from operating activities and take away capital expenditure, we get something called free cash flow, which represents the cash that is generated by the business. And now our final check is we also want to check the end of the period cash. So even if the business is producing cash from its operations, we also do want to check if they actually are building up more money on their balance sheet. So let's take a look at Corinthians cash flow statement. So the structure of the cash flow statement is, since it's all cash related, we start off with the business's net earnings, or in this case, net loss. And then all these adjustments over here are just to adjust whether it's a cash positive or cash negative. So you can see right over here, we have our impairment charge. Since that's not a cash charge, we can see that it's adjusted, and so it's added back here because it's not a cash charge. And you can see that becomes a positive, or not a positive, but it shows that there's actually being cash being generated from the operating activities. And so let's take a look at it from the high level. We have cash from operating activities. Okay, so it's going down, but it looks like it's improving a little bit to 41 million. And in terms of our capital expenditures, looks like that is also coming down. And so what that means is the business is starting to cut its investments into the business, which makes sense because the companies or the operations starting to decline, and is trying to maintain some sort of free cash flow. And looks like free cash flow has gone from 96 million loss or outflow to about a 2.5 million outflow. So they're somewhat stabilizing the business. Now, if we look into the individual items, we can also see what might be changing the cash production of the business. So a big one over here is prepaid tuition. So what that is if we're looking in the 10K, you can start to see what prepaid tuition is, and they discuss it in the discussion of the financial results. Is that prepaid tuition just basically means that they're getting some tuition in advance, and so that's a cash positive because you're getting cash in advance from students, and you can see that was a real benefit in 2012. But then that benefit goes away in 2013. So what happened, and this is also in the filing, is that the Department of Education, which pays a lot of the tuition for its students, they started to delay some of their payments. So they started to get less prepaid tuition, and since that becomes a negative, it meant they had to use more of their cash, or they had more of a cash outflow. So that's one of the reasons why cash was starting to decline. And now when we look at the end period cash, we can see, all right, so they went from 107 million to 50 million, right? So that's a big decline in cash. So we want to look at some of the other line items here, and we can see that most of it has to do with the financing activities. And so when we look at the individual line items, it looks like a lot of their cash is being used to pay down debt. So the story of the business there is that the business is not generating any free cash flow, even after cuts in CapEx. Prepaid tuition is becoming negative because they're not getting as much cash in from tuition upfront, and the business is trying to pay down its debt. That's why cash levels are declining. So once we get those metrics, we have free cash flow, and then we want to look as whether the business is burning cash from its operation. So here it is definitely burning cash. So now then the next question becomes, all right, so if cash levels are declining, then we have to start to look at the balance sheet of the business. The balance sheet of the business is like the financial health of the business. It represents what the business owes and what it owns. And the kind of simple framework is that if the business doesn't have enough cash to meet its obligations, then it becomes a bankruptcy risk, right? Because it doesn't have enough money to pay its obligations. So if we look into the business itself and we look at the balance sheet, really you want to look at two things. You want to look at the cash balance, and then you just want to check that their cash balance can meet its obligations. So let's take a look at Corinthian's balance sheet. So this is again the same period, and we can see that the cash balance has declined. You can see that is where it's gone down to 46 million, just like it shows in the cash flow statement. And then if we look at our debt, we can see that's about 122 million. Now, the way this is laid out is it's just what it owns. So it's the assets, and then what it owes. So it's the liabilities. So assets represents money that is expected to come in from these assets. Liabilities represents things that they have to pay money for. And usually it's divided between short and long term, and it's usually called current or long term. Current just means it either generates money or it expects to pay money within a year, and anything above that, it represents a long-term asset or liabilities. And then the equity statement represents essentially the money that is put into the business. So just really high level, we can see that cash is going down. There's a lot of debt, 122 million. And here's another tip for you. When we're looking at the balance sheet, there's a thing called accounts receivable, which represents if you make sales, but you don't collect cash right away, it creates a receivable, meaning like you're about to receive money. And because you sometimes don't always receive all the money that you get from your sales, you have something called allowance for doubtful accounts. Now you can see over here that Corinthian allowance for doubtful accounts has started to go up. It's gone up from 17 to 19 million. It's a sign that they're not collecting as much cash from their sales, but remember, their sales are going down. So that's also just a negative sign that the business is also not collecting as much cash from its business or from its sales. So the story of Corinthian is, well, cash levels declining. There's a big obligation of 122 million. So not a great sign. And really, now we need to figure out, okay, what is the nature of that obligation? So the kind of usually, or actually always in the 10K, you can go look into the debt section. They'll give you explanations of what the debt actually is. So in Corinthian, we can see this is their obligation. Most of it is in this credit facility. So credit facility just represents a loan from its bank. So what this means is that most of that debt is a loan from a bank. And the thing is, that is due in fiscal year 2016, right? And so their fiscal year starts around June. And so that's due in 2016. So that's due in June 2016. So that means at the start of that fiscal year, July 1st, 2015, that's when they have to start paying off that $120 million. So they have $120 million to pay off. And remember, they don't have a ton of cash, or they're not generating cash from their operations. And we check that from the cash flow. So it's not exactly a great situation. So just a quick recap, when you want to check the financial health of the business, on the balance sheet, first check the cash balance, then just check whether the cash balance can cover its obligations. And now, is there a risk of bankruptcy? If they cannot cover their obligations, that's a risk of bankruptcy. So now let's see what happens to this in practice. Let's just do a quick summary. So in this period, June 2012 to 2013, we have net loss. So the earnings of the business, and we adjusted it, has gone from 100 to just 2 million. So the business is barely breaking even. Now, free cash flow, we're doing a second check of, okay, what is the actual cash of the business? That's gone from negative 100 million to just under 2 million in terms of loss. So it's not bad, but free cash flow is definitely going down. There's no cash being generated by the business. Now we check the end of period cash. Now we know that 100 million down to almost 50 million. So there's 50 million of cash that's being paid out to debt. And the big thing is we know that there's going to be 120 million due by July 2015. So just from looking at these numbers, if we think about it, so for the next 2 years, if they have 50 million in cash, 120 million due, they basically need to make around $70 million in cash, right? Did I do that math correct? Yes, 120 minus 50 is 70. Yes. I spent too much time in Excel. So it's very clear that there's a lot of risk here, because if they need to generate $70 million in cash to pay off their debts and their business is not making any money and free cash flow is negative, well, this is definitely a bankruptcy risk. It's a huge financial risk. So what happened in practice? Well, in the first quarter after the fiscal year 2012, free cash flow just actually got worse. So even though they were starting to cut CapEx, they were trying to cut costs in their business, the free cash flow actually got worse in their operations. After that happened, the bank actually cut off its loans because their financial condition worsened. So they had no more access to loans from the bank. And the final thing is the Department of Education also put in a delay in student funds, or paying student funds. So they gave them another delay of when they would give them cash for their tuition payments. So free cash flow really started to decline. And so you can see that the only way out here, if you have to pay $120 million, is they needed to raise money. So essentially, over those 2 years, in 2013, 2015, they just went on a roadshow. They tried to find investors. They tried to talk to other banks. But the thing is, no one wanted a piece of this. No one wanted this. So once 2015 came around, they went bankrupt. And so what happens in bankruptcy? Bankruptcy means the company cannot pay its debt. When they cannot pay its debt, they file for bankruptcy, and usually the debt holders start to take control of the company, because then they're going to try to start recover their funds. Now, if you're a stockholder, it means you're the equity holder. Equities are the last in line when it comes to investors getting paid off. And because they're the last in line, and obviously if the company is going bankrupt, it probably doesn't have that much cash to begin with, well, there's usually very little left. So once a company files for bankruptcy, you can see the stock basically goes to zero. Now, the point is, this all sounds very obvious, but we were looking at financial statements around 2012, 2013. So we could see this financial risk was very clear around this time. And we had basically a 2-year window to see that this company was not going anywhere. And the kind of messages I want to communicate here is that sometimes people learn things about value investing, and it means like looking at book value and looking at the value of the stock. Some people would have actually thought this was a value stock, but this was not a value stock at all. This was a company about to go bankrupt. So that's why you really want to understand the financials to understand the story behind the business. And so the quick recap is, what are the 3 things to look for when you're looking at bankruptcy? You want to pay attention to the negative trends. If there's negative earnings, negative free cash flow, and a declining cash balance. Those 3 things means the company really is at bankruptcy risk, and you want to avoid those type of stocks. And so kind of the benefits of doing that, this is all part of the fundamental process, but one, you avoid the worst financial risks of stock. So really, if you can cut out the biggest risk of buying stocks, right, you really start to improve your overall returns. Just making better informed decisions, if you understand the risks that you're making, it means you're not going to get into any hype and buy up a bankrupt stock. You'll limit losses, which of course is very important for performance, and you'll avoid excessively risky ideas. These are all sort of the same kind of theme of, these are the benefits of using a fundamental process. And of course, when you use a fundamental process and you put in the work to understand stocks, well, the ultimate goal is you make more money with your money. Your investments make more money. You develop financial skills that really you can use in your career if you want to recommend stocks to other people, or you just want to be better at understanding financial statements. And of course, the ultimate process that you get is you have a logical process to make investment decisions. And then that way you can just reach your financial goals faster. So for action steps for today, for people following, really, it's very simple. I just want you to go to the Facebook group and just ask, what is the challenge that you have for evaluating the financial companies? And let's start to address that right away. Yesterday, it's like, what are your goals for stock investing today? What is the challenge that you have when you want to evaluate a financial as a company? And we're going to go over this in the Facebook group. And so let's address that. So important, we got one more day with the live event. And then on Tuesday and Wednesday, we're going to have our main event. And as just a reminder, there's prizes for grabs if you show up live during the 3 days. So that was yesterday, today, tomorrow for the live streams. I'm going to give out a free copy of the Better Investment Decisions book for people who show up and post in the Facebook group. And there's going to be one free spot for the Stock Investor Accelerator course for people who show up live in the free training webinar. And that's either on the 12th or the 13th. So if you haven't registered yet for the 12th and 13th, make sure to register. There's a link in the page that you're watching the stream. There's either one at 12 p.m., one at 5 p.m. And that's going to be great because we're going to look at how do we use fundamental investing to big create stocks. And of course, if you've already been registered, you'll see that you get a free starter training of how do you find stocks with fundamental metrics. And so I'm super excited to share with you this kind of stuff. Make sure to post in the Facebook group of any challenges that you have. And if you missed this, just don't worry. There's going to be a replay in the Facebook group. And I'm just excited to see you tomorrow and see you for the free live training on Tuesday and Wednesday. So now I'm going to go through a couple questions that have come up. Okay, so this is actually an important one. So a lot of times people ask, what is like, why free cash flow, right? So free cash flow, let's just go back over here. Free cash flow is, let's see. Okay, so why is free cash flow so important? So the thing is, if you notice that if we looked at this company's earnings, it was negative. But sometimes, say if you decide to get a lot of sales and then you decide to take a lot of sales in advance without collecting cash, sometimes you can make your earnings look a lot higher. And so that's why free cash flow is just a way as a check to see if the business is actually making money. So that's what we talked about with the balance sheet. So that's the final one. Yep. So you can see accounts receivable. So that's like one thing that companies can sometimes do. If they book in a lot of accounts receivables, you can make your revenues go up. But if you're not collecting on those revenues, then it means your cash is actually going down. So that's why free cash flow is like a very nice check to check if the business is actually making money. And so pretty much all investors, when you're looking at a company, you're always looking at earnings and you're always checking it with free cash flow. Or you do the other way around. You just focus on free cash flow. Okay, thoughts on liquidity ratios. Honestly, I think liquidity ratios, I've never used liquidity ratios in my entire time covering stocks. I honestly just used a simple of just looking at cash and debt. And honestly, I think that a lot of these ratios don't really help unless you just understand the basics of what the numbers mean. So you could have like a liquidity ratio here. And honestly, even like looking here, if you would look at the equity line right over here, total stockholders equity, you could see that it's actually going up. So I know sometimes there's like, you want to look at book value of the business. The book value of this business is going up. But if you just don't understand the relationship between the numbers, you don't understand that what these statements are telling you that this business is just shrinking and it's not making any cash and it's about to go bankrupt, well, then a liquidity ratio and book value metrics are really just not very useful. So that's just sort of my gripe with some of these simple ratios. Okay. Any other questions? Okay, cool. Well, we're coming up into the time. So thank you again for joining. I hope this was helpful. Come join the Facebook group. Remember, we got prizes for the next 2 days. And if you haven't registered, come register so you can see for our free training event on Tuesday and Wednesday. We're going to go over the fundamental investment process of how you pick great stocks. I'm Henry Chen, and thank you so much. And I'll see you soon.